All right. Hello, everybody. Welcome to this week's Forte Financial Mortgage Group podcast. This is our spring 2024, where we're going to cover some hot topics. What's coming up right now, what's going on in our industry, what's going on in the purchase market, what's happening with mortgage rates. You know, we have a lot of good stuff to cover. I have Chris Miller, one of our finest team leader.
And thanks for having me on again.
Senior loan officers here at Forte Financial Mortgage Group. So we're just going to discuss what's going on. There's a lot to talk about. And Chris, let's get into it. So the biggest thing right now that's just been crazy and on everyone's minds, well, there's two things. There's one is, the entire real estate commission for concern with buyers agents, but we'll get into that in a minute. But let's talk about specifically in this area in the East Coast. We're in Connecticut. Obviously, we lend in a lot of states all across the East Coast. But the bidding wars. I mean, the bidding wars for buyers.
Constant.
It's really crazy. It's funny because people back in 2020 when prices started to jump. Mortgage rates, we were giving people 30-year fixed rates at 2.5%, and prices were jumping. The amount of people we said, oh, nope, we're not doing anything. We're going to wait. These prices are getting crazy. And they sat on the sidelines, and they still haven't bought. And values have doubled in most cases in this area since then, and rates have tripled. I mean, not now, but Chris, tell us a little bit about what some of your buyers and your agents you're experiencing with regard to that.
I mean, I think it's a constant battle for most people. Most professionals in the industry, they try to tailor their offers to best suit the buyers, and at the same time make it more attractive to the sellers. But they're combating consistent multiple offers, cash offers, offers way over asking price. There's little trickery type things that they can do to make their offers more appealing here and there, but it's just a constant conversation that I'm having with realtors, and knowing what their pain is like. It's a challenge. Like, I get it. I've been there. It's not something that's fun to deal with when you're putting in 8, 9, 10 offers in a period of 6 weeks and none of them are getting accepted.
And it's interesting because you would think that's going to happen more just on the lower price points where there's even more buyers that are trying. I mean, I have buyers, around the $1 million price point that they're getting outbid and their offers are well over the asking price and they're not winning. So it's not just, in the lower price end. Let's talk a little bit about what we're doing differently or I mean, maybe not just necessarily differently, but to help combat some of this and help buyers win their offers. One of the things that we pride ourselves on is our speed. We get the question all the time, oh, well, how long do you need for a commitment? You tell me is the answer. You tell me how long. If everyone cooperates, buyer cooperates, gets us all the paperwork we need quickly, attorneys, that's the key. Attorneys get contracts done in a timely manner. It's not on us. This whole process is not just on the mortgage lender. Like, our job also relies on multiple people doing their job. Attorneys, the appraisers, getting appraisals done in the case we need appraisals. But our loan commitments are 24 hours in most cases from the time we have, the signed disclosures back from the borrower that we've sent them to e-sign to a fully written on a loan commitment is 24 hours. So we'll move as fast as anyone wants. I mean, I closed a purchase not long ago. First conversation to the closing was 9 days. And I mean, people talk about cash offers. I say, who cares? If you can close a loan, start to finish in 9 days, how is that not just as good as a cash offer? Because by the time you get into a fully executed contract, you have your title work done, it's going to take 9, 10 days anyway. It's not like you can close any faster. This is not something that our competitors are offering. I mean, I don't know any of our competitors that are doing that. Do you?
No, but I think that what most professionals don't realize is, like, when you're talking about the differences, right? We're collecting all the docs up front. We're doing our due diligence. We're running credit. We're checking liabilities. We're looking at income. We're doing all the things that need to be done prior to submitting the deal to a lender. And I think that is where we have the advantage, right? We're making sure that we're pre-flighting every single deal or every single scenario for the borrower before we submit, so that we are prepared.
Yeah.
And I think in that instance, like, okay, yeah, cash is cash, but if the income's been pre-written, the assets have been reviewed, it's been to an underwriter for a quick TBD scenario, and it's been looked over by somebody, in that senior level position, it's going to close. If we're doing our job, it's going to close. Now, if you were talking about people being part of the transaction, I had a deal get held up for homeowners insurance because they had their favorite homeowners insurance person, but they didn't respond for 12 days to an email that we followed up with multiple times. So it's possible to close that fast. Like you said, as long as all the professionals that are involved are doing what's best for the borrower or the buyer.
We have our own, I don't even want to call it a preferred, providers list, but the people that we refer out are people we have absolutely no affiliation with. We do not benefit monetarily from anyone we refer. We refer out based on the fact that we know they're going to get the top service in that department at an extremely fair price. We see loan estimates, closing disclosures every day from every other service provider, so we know what a fair price is for those. If you take thousands of transactions, we know what a fair attorney's fee is. We know what a fair, homeowners insurance policy is. Given that's a little harder sometimes because there's some different nuances, not just necessarily based on the basics. But still, the point is, to the clients and realtors, we're not referring out anyone that is going to hold up the transaction or that's going to give the borrower a crappy deal, because that's the key. Like, our forte is it's all about being the best, and the best has everything to do with price. Like, just because someone's good, just because someone's fast, that doesn't mean they're even remotely a good referral source if they're going to charge more, if it's going to cost the borrower thousands and thousands of dollars more. Let me just touch on that. I know we're going off topic here, but I was so disturbed by this. I was absolutely disturbed by this. We have a closing in Florida. The title company, I asked the title company, hey, please send us a copy of your title fees and preliminary disclosure, so we can update our loan estimate and give the customer the correct adjusted numbers. And they accidentally sent me the wrong. There was actually a closing disclosure for another loan that they're closing with some other company, not us, obviously. And I was appalled. I had to say, I said, listen, you sent me the wrong disclosure, but clearly I had to look at it to realize it was the wrong disclosure. And based on, it was an FHA loan, and they were literally paying 3 points for a rate that we could give that borrower at 0 points. Like, it's appalling to me. And this goes back into the whole steering and, that we've talked about in the last podcast. So it's crazy.
I think continually to build our reputation, so that when we say we know we can give you the best deal because we've shopped it amongst, 25, 26 lenders that we have now that
I think it's
that
more.
We search it against.
I think it's more.
When we say that we know we can give you the best deal, it's because we're actually seeing what other lenders are giving. We're shopping their rates against our rates daily, and we know what a good deal is. Mm-hmm. And we're saying that in a very serious way because we see what, like you said, you have a perfect example of what somebody shouldn't be paying for a loan. And the problem is that either maybe they were referred to the person through, either a friend or a family member, or maybe a realtor, or maybe an attorney. Like, you don't know who referred them, but the bottom line is they didn't shop it. So unfortunately, they're not being an educated consumer in that way. Yeah.
And listen, the due diligence goes back onto the referring source. And I'm not saying, well, if it's a family member, no. I mean, family members, they're not in the business, but a realtor or an attorney that's referring a mortgage company, if they're referring out somebody like that, which there are many, unfortunately, that to me, they should take some ownership on that. Get to know your lenders, realtors that you're working with. Get to know their pricing. Have a few different types. If you mainly refer to a non-bank lender, make sure you also have a wholesale broker. Make sure you have a bank. Get everyone's comparisons. Tell your customer, get a comparison from all three. Just what are you all doing to make sure you're helping guide that buyer to to make the most educated decision. Aside from here's 3 cards, like that's good, but there's another step to help make sure. And I just think that more of that needs to be done. And hopefully our podcast will help educate more consumers and agents.
Just encourage people to take the time to actually, like you would for most products, shop around, look at reviews, talk to people.
Yep.
Get opinions, look at those conversations and have those takeaways that really going to turn into savings for you.
Yeah. Yeah. So, buyers, it's frustrating. It's really frustrating right now. I know, with you're putting, over asking offers. The only thing I want to touch on, which kind of we can segue into one of our other topics today, which is rates and, hey, what's our expectations in our analysis for the rest of 2024? Now, it's obviously it's Q2 at this point. Most of us expected rates to start to come down a little bit more by now. It's April. We're filming this on April 4th, 2024. We did expect it to happen. The good news is, though, at the last Fed meeting, Jerome Powell did confirm that 3 rate cuts are still on the table for 2024. Although there's been some conflicting info. I know he spoke last week on Friday, and there's people thinking, oh, we're not going to have any rate cuts this year. Our expectation is that, I think the March CPI report, which is coming out next week on April 10th, will have positive numbers in terms of inflation coming down. I think so. And I think we're definitely going to start to get our rate cuts in June. I do. And, get ahead of this now because, many of you, Chris, I'm sure you've seen Barbara Corcoran, her, whole outlook and view. She recently was on, I forget what CNBC or whatever it was, saying, hey, you think that prices are really high right now? Okay, well, when mortgage rates drop 1% from here and down to at least 6%, which for us will be well into the 5s when our competitors are at 6, the amount of more buyers that are going to come off of the sidelines that are purposely not looking because they think rates are too high is going to drive prices up further in the areas that like we're in right now. This isn't, I've never seen it more divided. There's areas in the country that there's the price cuts and houses, that's not here. That's not in this area in Connecticut that we're in, New York, New Jersey, this Northeast region. So the point is, if you're on the sidelines waiting for rates to drop, that may be a mistake. You may have to pay a lot more for that house at a lower rate, when if you buy today, you can just refinance that. As you know, we offer our free refinance program for our customers where we drop the rate and give a full lender credit once the rates drop enough. So you buy now and pay less price, refinance that rate later at no cost. You kind of cover both sides of that coin. So, please don't assume that when rates drop, you're going to just get a better deal. I don't think that's going to happen anytime soon. What are your thoughts, Chris?
I'm constantly telling people to marry, the old saying of marry the house, date the rate.
Yeah.
And just reiterating that over and over again to help alleviate the concern. Rates are not permanent. Maybe they have been for the last 18 months, but they won't be that way forever. And, if you found the house of your dreams now, you're better off just going after it. We deal with the higher interest rate, whatever that is, or we look into a buy down. There's plenty of, maybe a seller concession to help get the rate down. There's all kinds of tactics that you can use to combat the higher rate, depending on, what your credit score is, what the down payment is, and all those kind of scenario questions. But I think that's just one of those things we all just have to work together to help people realize that right now is probably the better time to buy if the house that you want is out there. I think inventory is another question, countrywide. There's still lots of issues with inventory, and that in itself drives prices up. But you touched on something in reference to combating multiple offers. And I think that relationships in itself is something that helps in that scenario. One of the things that some of the agents I work with have started to do is that every offer they place on the buyer's behalf, they're CCing me on those emailed offers to the seller's agent. And we're engaging with the seller's agent, having that conversation about what type of pre-approval was given, that we've checked the bank statements, we've checked the credit, we've actually looked into it. We didn't just hand them a paper pre-approval and just said, here you go, based on some information that you told me. We've actually taken intake and reviewed that to ensure that when we're giving out that pre-approval, it's valid, and that there's, for every good reason that the loan should close.
I like that a lot, because usually it's, oh, hey, the seller's agent wants to talk to you. And I welcome those calls because, first of all, there's a lot of loan officers that work for companies that really have no business sending pre-approval letters, because they're just sending letters based on, many of them haven't even pulled credit. They haven't reviewed income documents. They have basic, your napkin app, and, oh yeah, here's your pre-approval letter. It's really frustrating for us. But so I tell our buyer's agents, guys, I get it. If I was a seller's agent, I would do the same thing if they don't know me, because there's a lot of bad eggs out there, So, but obviously once they talk to us in 3 minutes, they know that we're the real deal. So I like that. And plus it gives us an opportunity to build a relationship with them as well. You never know where that leads down the road. But we were discussing earlier today some of the tools, like, for buyers that are transitioning out of a current primary residence, buying a different primary residence, because this is something I feel like that's going to happen more and more when rates start to drop. Like, let's face it, the reason why there's no inventory is because so many people have a mortgage rate in the 2s, 3s, and 4s that say, I'm not selling and getting a 7% rate. But when the rates drop and they can come and get a 5% rate. Now, if you were at 4, it's like, oh, okay, well, you know what? I think that's kind of worth it, because I am going to get something I really want. You're going to have more inventory come off, but those people are also going to be in the game now trying to fight for a house. So some of the creative things that we've come up with to help those, I'll talk first about the first one, which is pulling a HELOC. So if the point is, if you're potentially looking to sell your house, buy another house, and you don't have the down payment, or you need more of a down payment, you want to think about that now before you list your house. Because one of the things that we've been doing for a lot of our clients is getting them a home equity line of credit, which we can offer up to we can actually offer up to 95% of the value of the home, but most of the ones we do are 90% or less, where in most cases we don't need an appraisal, and we can close from start to finish in 2 weeks with very minimal closing costs, and in some cases no closing costs, depending on, there's everything's a little different. But the point is, do it now. Hey, if you're not drawing on that for 6 months from now, guess what? You're not paying any interest. It's not costing you anything for it to sit there. It's like a credit card. You don't pay unless you take it. But if you wait until you list your house and say, oh, it only takes 2 weeks, let's get a HELOC now. Nope. The fact that you've listed your house for sale excludes you and disqualifies you from pretty much all home equity lines of credit programs, because the intent is that it's not supposed to be a short-term loan. Granted, there's no prepayment penalties on ours. So if you do take one out and you end up paying it off a year later, it's not a problem. There's no penalty. But if you've listed it for sale, then we know, hey, you're definitely going to pay this off early, and we're not going to give it to you. So give us a call if you want to look into your options for that, to get that in place now. Again, very fast and easy. We're getting them done. But Chris, you've been talking a lot, which I really want people to be educated on, something that they know probably less about than the HELOCs are bridge loans. Why don't you talk about the bridge loans?
Yeah, we've had the conversation with a number of people at this point, sitting on maybe either 50% equity compared to what they owe, or 60% equity compared to what they owe, or maybe they have no lien whatsoever. But so the bridge loans that we offer can go, essentially up to 75% of the house's value. And you can pull that cash out, literal cash, as part of doing the bridge loan to use to purchase the next primary residence. And the nice part is, they don't care if your house is on the market. They actually want your house on the market. So let's say you're looking to purchase, you're looking to downsize. And so maybe your sale price, the selling price of your current primary is way higher than the next primary that you're going to purchase. The majority of the cash that you pull out on that equity is probably going to cover the majority of your next purchase. So the nice thing about that is, you may not even have another mortgage on the next house. until you actually complete the transaction. But when you do the bridge loans, there's no payments for up to 12 months. So you're not adding a liability to your debt. You're not affecting your debt to income ratio. You're not hurting your credit score. I mean, essentially you're going through a mortgage process, but you're giving yourself buying power. You're making the purchasing process easier. Is there costs? Absolutely. Like anything that is a benefit. But at the same time, it also gives you, a huge advantage over some borrowers that may be only putting down 3% or 5%.
So let me stop you for a minute. Very good stuff here. This is awesome. I think this is probably going to be one of our highlights of this podcast because you hit on something that's really important. And I think a lot of people who think about a bridge loan get nervous, costs expensive, and now they're pulling all this money out and they're going to have this huge payment because they know the rate's going to be higher. And then they don't know how long they're going to sell that for, so that's going to stress them out. You just said there's no payments for 12 months.
There is no payments for 12 months.
So
as long as you are actively marketing your house for sale or under contract, and maybe there's a delay in the time from when you go under contract to the closing, but you have 12 months with no payments on that equity that you've pulled out as cash to purchase your next place.
That's awesome, Chris. Guys,
it's an easy program. I mean, the guys that do the program with us, the underwriting part of the process is relatively simple. It's fairly similar to the exact same underwriting process you would do for a regular mortgage.
So how long can we get a program like this done, Chris?
I would say about 3 weeks.
It's awesome. All right, so there you go. If you've already put your house in the market, you didn't listen to this first, you didn't get that HELOC in place.
And you're struggling to get offers accepted because maybe your down payment is only 10% and you're getting beat out by somebody with 30, 40, or 50%. Here's your way to combat the market.
I love it. That's how you fight cash buyers, people. Bridge loan. Of course, you have to own a house that you're trying to sell. If that's not the case, then this doesn't apply. But there's a lot of people in this. And the point of why we're bringing this up now is because rates are going to come down. Like we know they are. The Fed has forecasted it. They've been very clear about their plan and their intentions. It's just taking a little longer than everyone expects. But with the last meeting, a confirmation that 3 cuts are still on the table. Guys, this assumes no geopolitical black swan type of event that could potentially happen, especially in an election year. Rates are coming down. And when they come down, the inventory that's going to come on the market are going to be from sellers that are it's now worth it to them because now they can get a mortgage that's not at 7% on their next house. So this is going to be coming more and more. If you find yourself in that situation, give us a call. We'd love to help you with a bridge loan. But let's talk about rates for a minute, all right? Every podcast I listen to, when I hear somebody talking about rates, and you hear a lot of non-mortgage people, especially having these conversations. The number that I hear them spit out for the most part is 7%. When I say, "Oh, rates today are 7," so no, they're not. Actually, they're not. Maybe with a lot of our competitors, they are. But right now, if you're someone that's sitting on the sidelines, and you have minimal money and you're thinking, I can only afford to rent, we can give you a 30-year fixed rate loan with only 3.5% down at a rate in the mid-5s. 30-year fixed, mid-5s right now. We can offer that today, April 4th, 2024. That is possible. That is very realistic. And you don't even need to have an 800 credit score to get that. So, there's just so many tools that there's just so much negativity out there, and just bad information. That's the point of this podcast, is to educate and people know what's out there. So, if you're a renter on the sidelines thinking you want to wait for rates to drop, or you're trying to save more money, you don't have enough of a down payment, I really think you should think about doing it now when you consider the fact that you may be paying 8% more a year from now for the same house, when the rate is only going to be maybe about 1.25% lower, which we know they're going to come down. You're right, they are, but you're going to pay more, most likely, unless you're in an area that inventory is not a problem and houses are not going for over asking. If you're not in one of those markets, fine. You want to sit on the sidelines? Absolutely. But if you're in this market like we are, where we're fighting every day, I think you're going to be at a disadvantage if you wait. That's my opinion. This isn't a push to try to get people to buy. This is education. I mean, if I'm wrong, I'll call it out on a future podcast. Say, hey guys, I was wrong. I said this was going to happen and it didn't. I just think there's just too much. There's too much factual data to support what we're talking about.
I don't know if you mind, but I've been wanting to talk about a free refinance that I'm working on right now, because I think that the misconception that rates are not good enough to refi is way off base.
First of all, you can talk about free refinance all you want. It is my favorite topic because it is the one thing I feel like is like, for me personally, it is the thing I'm the most passionate about in this industry is the way we structure our free refinances, because nobody does it. I'm not going to say nobody. There's obviously going to be some outliers.
No, but the way that we do it is totally different. And,
it is.
And you know what? We're not going to give away our setup of how we do it or but we know that we can do it. I have somebody right now.
Tell us.
You and I worked through the whole deal together, right? They bought a new construction. The depository bank that did the loan for them was at 8.25%. This was in 2023. Most of the year rates were not that high, but 8.25%. So they've been battling back and forth with the bank for probably 6 months, getting them to do a loan modification to lower the rate. And the best that they were offered so far was 7.25%. Well, we're doing the Forte Financial free refinance for them at 6.577. And it is literally costing them nothing other than prepaid interest because they're going to miss a payment for 1 month. 6.577. So they're going from 8.25%. It's literally saving them $564 a month.
So
and it's costing them nothing that doesn't go towards the actual payment structure of the loan. The prepaid interest is for the I think 7 days that they're not going to be within that payment period.
People, there is no catch. The biggest problem we have with this program, people do not believe us. They think there's a catch. They think there's a hidden fee, and there's not. The reason we can do this is because, first of all, if our rates on average are 0.5% or better lower than our competitors, like the only reason that our rates are that much lower is because we work on much smaller margins. We don't have tons and tons of managers and employees and buildings and processes. We're not a small company, but we're not. We don't have the overhead that these other non-bank lenders have with tons and tons of overhead, so we can afford to do things for less. So we give a percentage of our premium, we call it, to pay the closing costs. And what's relevant is people say, oh, well, you're just jacking up the rate. Okay, so if you went to your local bank, okay, and they offered you 6.75% on a refinance, and you were going to pay $5,000 in closing costs. But if you came to us and we gave you 6.57% and gave you a full lender credit that actually paid your closing costs for you, like that's what we're talking. When we talk about this free refinance, we're not talking about, oh, well, the bank offered a 6.75 with $5,000 in costs, and we're going to give you 7%, but we're going to pay your costs for you. Right. That would support that argument. But our rate's actually lower, and we're giving you credit.
You have no closing costs.
We have a lot of information on this on our website at fortefinancial.com. We even have one of our attorneys in Connecticut, Attorney Anthony Iorio, who is on a previous podcast, who has probably closed 200 of these for us in 2020, 2021, probably 200. And he's on there explaining, yes, there is no catch. Nobody else does this. He's not our attorney. There's no affiliation. It's just somebody that understands our work ethic, understands how we work, does an amazing job. Customers love him. That's why we use him. But you can listen. He'll tell you. Watch the podcast. Don't hear it from me.
I mean, we could even show you a loan estimate to prove out what we're talking about. I mean, that's we can obviously blank out the customer's information, but it's on paper, in true form, signed and dated, moving forward.
Yeah.
It exists. So if you're over 7.5 or maybe even low 7s right now, you still might be able to get into a refi at through our free program.
Well, and that's the thing, and I know we're repeating things that we've talked about in other podcasts, but the people watching today aren't going to go back, most of them, and watch a podcast from 8 months ago. So we need to repeat some of these things. One of the big things, is as far as the closing costs are concerned, is like people think, yo, I have to save a full % off the rate, or no, I'm not going to refinance now. If we know rates are going down, why are we going to do that? I have a lot of reasons why. First off, nobody can control the market. Like, rates actually started coming down in January. The 10-year bond was at over 5, remember? Came all the way down to about 3.8 at its lowest recently, a couple months ago. And guess what? It had ticked back up to around 4.3. So, like, this is 10-year bond is, for the most part, what controls when 30-year fixed, conventional mortgages go up and down, for the most part. Like yesterday, the 10-year was up, but rates started to come back down because of some other reasons. But the point is, if we're giving you this loan, you're saving a few $100 a month. We're giving you a full lender credit, which costs you absolutely nothing, and you can save a few $100 a month. Why would you not do it now? Because one of our only requirements on our end is we do this again. We have clients who've done this for, 4 times as rates continue to drop. And that is not predatory lending because these people didn't pay any closing costs.
Right, they're saving money,
and
you're
they're
not
saving
spending money to do it.
And for the naysayers to say, oh, well, we're going back to 30 years every time we do. No, you're not. Not unless you want to. We have odd term. We can set your term at 29 years and 7 months. Whatever you want, we will do. We can do an odd term. So, it does. Or some people come in and say, well, whatever, $150 a month. All right, I don't need to save $150 a month because it's not worth my time, even though our process couldn't be any easier. Fine. All right, well, how about instead of saving you $150 a month, we keep your payment exactly where it is, but instead of you having, say, 29 years left on your loan, now you end up with 25 and a half years on your loan paying the same payment. Why would you not want to save 3.5 years?
I mean, the amount of money saved in interest right
but
there
why?
is insane.
Like, to me, it's just, it's again, the main problem is just people think there's a catch, and there's not. There's not. It's all over our social media. We have attorneys who have closed these loans that will confirm it, that we have no affiliation with. We're doing special things here, very unique, special things. You know, I get fired up. We talk about free refinances.
Without a doubt.
It's special.
Your project.
It's special. It's special. Let's move on to a couple of other things. So one of the things that we're pretty pumped about, we as well, our viewers, we're also a lender in the state of Connecticut. We're not just a broker, and we just rolled out a special jumbo program for our Connecticut, buyers and homeowners, where our rates are really competitive on this program. And, one of the cool things about it is, a lot of people that are trying to take cash out of their homes, Fannie Mae, Freddie Mac, the GSEs, government-sponsored entities, have instilled some pretty significant hits or adjustments, LLPAs we call them, so the rates take a nice hit, if you're at 75, 80% loan to value. This program we have, the rates are super low. There's ARM options, low ARM rate options. There's no hit for cash out in this program. So they can go up to 75 or 80%. There's different buckets in the program with no additional hit over what the rate would have been on a purchase, which is huge. I mean, most loan programs, the rate is probably at least 0.5% worse for a cash out loan in most, not all cases for sure, but in your conventional types of loans, in most buckets, it's probably about 0.5% worse for a cash out.
And you don't have to have an 800 credit score to get these kind of things.
I'm talking at 75 to 80 loan to value. I'm not talking like a 60 loan to value loan. Yeah, there's a minimal hit for cash out, but most people are on that 75 to 80%. And obviously if you need higher, we have your HELOCs. But so that's pretty exciting. If you're in the market for a jumbo loan in Connecticut, you definitely want to reach out to us to see what we can do. It's a special program that we're excited about. We know what our competitors are doing, and it's special.
It is very aggressive pricing.
Yeah. So I think we mentioned the rate cuts. Just one last thing on the rate cuts before we go into the hot topic of realtors and buyers' commissions and all of that going on is our forecast for rate cuts. I do believe we are going to see 3 rate cuts this year from the Fed. I think it's possible we could get more. With a lot of our CPI for the month of March, this consumer price index, which is really what has driven a lot of what's happened with the 10-year, the commentary from Jerome Powell and the Fed. I think it's going to come in, lower, than anticipated, not by a lot, but lower. I mean, just based on there's so many factors that really skew the January and February numbers coming in a little hotter than expected, that if you look at some other countries' CPI, same thing happened in January, February, and this month for March was much lower. So I think we're going to see some of that here, and I think that's also going to continue into the next couple of months. I mean, we have 3 full CPI reports coming up before the June meeting, and I think rates will be cut in June. And to be clear, again, that does not lower mortgage rates directly. It will indirectly impact it because it will push the 10-year Treasury down, which will definitely drop mortgage rates. But directly, this is the thing too. A lot of people that I'm glad we're talking about this, HELOCs. HELOCs are directly tied to prime rate. So if the Fed cuts rates 0.5%, your HELOC rate is going down 0.5%. Every single HELOC that we do, every single one I've seen, a customer statement is tied to prime, and it will immediately go down by whatever the Fed cuts rates. So if we set up a HELOC for you right now, and the rate's 9.5%, we'll just say, because prime is very high, it's 8.5 right now. Your HELOC goes from 9.5 to 9, like that. And it's not like, oh well, I closed earlier when rates were higher. No. That rate will just go down for the life of the loan if prime goes down. So keep that in mind. Whatever you take now in a HELOC, the reality is that payment, those terms are just gonna get better from here. So
I just want to touch on this. I'm reminding people when we're talking about HELOCs, and the prime rate and how that's affected. Your credit card rate at 29.99% is not going to go down when the prime rate goes down, but your HELOC rate will. Mm-hmm. So get rid of those credit cards as fast as you can, and if you have equity in your home, the HELOC is the way to go. Not only does your interest rate drop immediately, but as rates drop, it's going to drop even further.
True.
And we've seen a lot of that, people in coming out of the holidays still, even though we're in the the beginning of the second quarter talking about debt that they accrued and vacations and things. So HELOCs are where it's at. They're higher than a traditional mortgage rate, but they're certainly not going to stay there.
We're doing a ton of this right now. HELOCs. First of all, people are starting to get immune to higher rates, I think. But it's at this point it comes down to benefit, and you can't just look at I don't want a 9.5% rate. That's ridiculous. What are you getting for that? Is it worth it? Like, if you don't take it, what is the alternative? And in many cases, the people that want or initially thought they wanted it, it doesn't change that it makes sense. People get fixated on, I don't want 9.5% rate. That's horrible. You just got to remind yourself, are you paying off debt? Are you doing a home improvement that, you really want? It's probably still worth it is the point. Yeah. But hey, that's not up for us to decide. I like to give the information. I like to make sure people are really making educated decisions on what they do. Chris, before we wrap this thing up, although actually we still have a lot of time today, but the big hot topic today is and I'm talking to a lot of my realtor friends, and the big talk is that buyers agents with the whole commission settlement, lawsuit, the class action lawsuit, that buyers agents are really going to suffer. And I've got a lot of stressed out friends that are mainly buyers agents that are like, I don't even want to do this anymore. Like, why am I going to do this anymore? You know more about it, Chris. You were a realtor first. You know a lot more realtors, so you're a little bit more in tuned, and you've talked to more people. Let's give some thoughts on this.
And I'm getting the same type of feedback. Everybody's really, not necessarily nervous, but frustrated, I think. Things were a bit simpler before this class action lawsuit, and I think that it's going to force negotiation on the side of the buyer's agent, where in the past, it was relatively simplified, right? The seller's agent would contract with the seller, and they would come up with what the total commission would be, and maybe they offered out 50% or less to the buy side, and it was posted on the MLS. All that stuff's going away, and some agencies are dealing with it different than others. Some some brokerages have settled, throughout the class action lawsuit. Some have not. Some of the smaller companies haven't. And talking to different perspectives, some larger brokerages that are big corporate ones are some of the smaller ones, I think they're all approaching it in different ways and trying to come up with ways to combat it. A lot of it is about verbiage used when talking with a seller, about how to kind of navigate that part of it. But then there is the buyer's agency side of it. There's a lot of people that survive solely on being buyer's agents, and now having to navigate that when there's probably going to be realtors that'll work for either a flat fee or an hourly fee, and not what they would normally make, as a full commission, we'll call it. I don't want to actually name a percentage, but as a full commission that they would normally receive, it's a huge business decision to figure out how to navigate that and what the navigating tools are or the negotiation tools are for that. It's going to affect the industry overall. It already has. Like you said, I'm hearing the same things. People are frustrated with it. They don't want to have to put in an offer on their buyer's behalf in a competitive market and then say, oh, by the way, seller, because you didn't advertise a commission, now we're asking for you to pay the buyer's agent commission. It's going to make the offers less competitive.
Yeah.
Especially when there's agents out there that will work for less. How do you combat that? And I think that they're all trying to figure this out, and there's no definitive answer.
Aside from how that's going to come out in the wash, there's obviously that's not for us to decide, but I like to think about how can we help realtors and buyers both. What can we do? So a couple of things that I just thought, two very different pieces of it. One is for the realtor, one is for the buyer. But as far as for buyers go, buyers who now have to pay, because the negative thing for buyers is now that buyers now are responsible to pay whatever the buyer's agent is going to get for the agreed upon fee. It's their responsibility now to pay the realtor, whereas it was the seller's responsibility that the total commission was split by buyer, seller, realtor, and paid by the seller. That is now whatever percent is for the buyer's agent, the buyer has to pay. So you're talking about the concern is loans that are 3% down loans, if people have minimal down payment, like that's crippling to a buyer.
Yeah.
So, we have a lot of creative solutions here that are very unique where, like for someone doing an FHA loan with 3.5% down, offer up to a 6% seller credit. So, so we can finance in all the closing costs, and we can also do a 0% down second mortgage. So I don't mean that didn't come out right. You know what I mean? But a second mortgage to give them the 3.5% down payment. So there would be no down payment in that case, nothing out of their pocket aside from, an appraisal, a home inspection, things like that.
Yeah, but the original 3.5% down can go towards the covering of the buyer's agency.
That's the point.
Yeah.
It's a creative way that the buyer doesn't have to come up with another 3% or 2% or whatever that buyer's fee is going to be. We have some really cool programs that will help facilitate that. So keep that in mind, realtors. We can definitely help you offset it that way. But for those realtors that are hustlers, working hard and really, really pushing things and nervous, you made the transition, Chris. You were a realtor, and now you're here, and you wouldn't even think about looking back. It might be something for an opportunity. Hey, what's the silver lining? There's got to be a silver lining. I think that this could be a great opportunity for a really aggressive hustling buyer's agent to make a transition to this end, which we would certainly entertain with your with your approval, of course, because you did it. Like, maybe talk a little bit about what some of that experience was like, going from being a realtor. I know you did both buyers and sellers, but what was what advice would you give anyone that is stressed out, that thinks they probably want to do something else? Hey, this is a great possibility for some of them.
I think it's just an alternative. It's a similar industry, right? So your industry knowledge kind of carries over. There is a whole different education piece and the financial background part of it, and that education is different. If you weren't really into the financing part of it as a realtor before, it might make the transition a little challenging. But the relationship piece is there, which for me is great, right? Like, we can go back and work with people that we always love to work with, getting to have those conversations, but in a different way, maybe getting to help that agent that, normally you would just, you're cooperating with them on a transaction, buyer, seller's agent, whatever. Now you're assisting them with getting their buyer's offer accepted, or, getting them to, maybe a deal's falling apart with somebody else and they're looking for help or a way to, creative way to fix something. You have that relationship because there's the trust there from prior dealings together. So I think the relationship part of it is what makes that crossover easier. I think it's just a matter of just working in the same industry in a different way.
Yeah.
I really enjoy it in that respect because the relationships for me is what it's all about.
Listen, it's not for everybody. There's no way, and not
But
everyone.
neither is real estate.
Not everyone that's a good realtor is going to be able to make a transition and be a good loan officer. It's just different. It's very different. But the point is, like you said, it's a similar industry, and it's very tough bringing new people on. And this is so in an upcoming podcast in May, we're going to talk about what it takes to become a loan officer if you have no experience, you haven't done anything, and what that looks like, getting hired, training, programs, hours of education, testing. We're going to get into all that, which isn't fun. But I think that it'll be educational for people thinking about doing it and potentially realtors that want to know what it's all about. So that'll be coming in an upcoming podcast in about a month from now in May. So there's more to come on that. Just in terms of loan officers and being a loan officer, I want to touch on a little bit of hiring stuff that, it was funny. You came to me, you were out at a visit with one of our lenders a month or two ago, and you said, hey, I talked to a lender, from another mortgage company. We're not naming companies' names and never do that here. The point isn't to put anyone else down. It's to educate people. And they said, oh, well, they were saying about how they get paid. They get paid a 1099 from their mortgage company, and then they just and they keep the whole commission, and then they pay a flat fee. And it's absolutely insane to me because that is not compliant. It is not compliant. I know these companies have 100 different reasons, and all our compliance attorneys. How many big banks do things that pay millions of dollars for compliance that get fined billions of dollars all the time? Just because somebody's doing it doesn't mean it's legal. The point of that, we're going to get into that with our next podcast guest in May, who has a ton of experience dealing with compensation plans and regulatory. And but the point is, the only point I want to make at this point without getting into it is loan officers. It's not just illegal for the company. You're also at fault. It is your responsibility to know compensation rules. So if there's a problem where the company is caught doing this, you could lose your license too and your livelihood by doing this as a 1099 employee. It is not legal. There are some gray area in a few states, which is what these companies that are doing it latch onto. But there's so many layers to it that, at the end of the day, it's just not legal and it's just not worth your livelihood. At the end of the day, if I did a comparison with what these companies are actually paying a good loan officer versus what we would, and when you factor in the 1099 write-offs and all that, you're still going to get a better deal here. But point is, be careful. Loan officers, if you're being courted, because right now the solicitations from mortgage people jumping, switching companies, changing, and these companies offering you a 1099, it's not legal. And if that's caught, which I think is just a matter of time, and many companies have been caught with this, it's just a matter of time, and you could lose your license too. So just know what you're getting yourself into, and just don't trust them saying, oh, we have our compliance attorneys and our lawyers that, that found a way to do this. It's not compliant. I just wanted to put that out there for now, I think that's all I have today, Chris. Is there anything you wanted to add to kind of the
No, I think we touched on a lot of the hot topics, other than just continuing to have the conversation about rates and having, I think, realtors advising their clients to shop around a little bit, because maybe your in-house lender or the bank that they use, for everything else for their business or for their personal life doesn't always have the best rate. Most of the time, they don't.
Yeah.
So if you want to save your clients money and still give them the best service that's out there, give us a call.
Awesome. All right, well, listen, viewers, thank you so much for listening. Chris, thank you for your time today helping educate. Hopefully this was educational.
Always fun to be here, man.
All right, take care, guys.